Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. After making a low on September 19, December corn has not changed very much over the last 2 weeks. It's currently trading very close to where it closed on the 19th of September, and right now key support we believe rests at 348. Just below that 348 number, we have the major previous low that came in at 344 and a quarter. And that 344 and a quarter actually happens to coincide with 2 standard deviations below the point of control of 386. So at this point, we believe that corn will perhaps move sideways to slightly up over the next week or so, till perhaps about the 15th to the 19th of the month, at which point we think another leg down is probably due, where the market could very well come in and break that 344 number. We're looking at a potential baseline target somewhere in the neighborhood of 335 to 338. And upon doing so, we think a significant low could very well be in place for which the market could bounce from. By the looks of the movement today, despite being down for a good portion of the day, we do see that the market has recovered much of its losses and is posting what's looking to be a potential reversal run. And if there's good follow through for the rest of the week, the market could very well come back up and retest the 315-degree mark near 354. Right now, we continue to believe that the 348 mark is very important. In the event that the market closes below the 348 number this week, that could mean that the market could head lower sooner rather than later. And if it's able to hold above 348 for the balance of the week, we do again think that a test of 354 could very well be in the cards before the next major leg down for this contract. As far as November beans are concerned, we had previously discussed the importance of the band of resistance overhead that rested at 979 and a quarter to 984. You can see here where the market came in and gave us a snapback reversal against the top end range of that region, and the market has been declining since then. We're looking at a market now that has been down for the last 2 weeks and is finding some potential reasonable support coming in just above 950. If the market's able to hold this 950 mark for the balance of the week, we could see a slight bounce to retest previous highs. In all likelihood, though, we do believe that the market is poised to continue lower with minor pullbacks along the way. Part of why we're looking at potential support from today and yesterday is that the market is sitting up against our 270-degree mark at 952 and a quarter. And from here, once the market is able to break back below this 952 number, we think one more minor drop is possible. We do have volatility-based support coming in at 938 with the bottom region touching 920. And so once the market is able to break this 952, we could see some minor support coming in somewhere close inside that 920 to 938 region. We are also approaching being oversold for this market, which suggests that once this market does break below being in an oversold position, we could see a minor correction or a minor bounce to the upside. Even still, we do think that the fundamentals continue to point for continued weakness for soybean, and until one more break potentially of this previous major low from August 31st, we anticipate that a signaling of a major low would finally be in place. Granted, depending on how well the market does hold up against volatility-based support here is going to be very important. And if the market's not able to really breach well below the 938 mark, we could be in a position where the market has already baked in much of the downdraft for the move, and we're simply going to see a sideways movement with incremental bounces to the upside as we move into the November timeline. After making its low on August 29th, the December wheat contract continued to move up as it approached the quarterly report. As it was making its advance, we believe that it was going to find difficulty getting much higher than 468 and a quarter. That's exactly what we saw occur for this market here, and we can see over the last week or so that the market has been in a steady decline after that small minor pullback. That retracement was just shy of a 38% retracement and just beyond a 25% retracement. And we also wanted to get a feel as to where this top could potentially land. And in doing so, we wanted to use the actual price action from the chart using the significant low from the August 29 low with the next impulse move up to give us some projections as to where that top may come in. We use the Fibonacci expansion model to give us those projections, where point A and point B was the initial impulse, and then we took a measurement using Fibonacci ratios from point C to give us a forecast upward of potential levels. The first level that you'll see is the 100% level, coming in at 453 3/4. When the market initially reached this area, you can see about 2 or 3 days of consolidation, but eventually the market was able to break through, and in doing so, it broke through our 180-degree mark of 455 1/4. Of particular significance, and as we've talked about this particular area in the past, the 127% mark, or the 1.272 of 460 3/4, ended up being the very important area that projected for us the reversal point for this contract, and in doing so, the market has since been moving down. The next key support level that we're looking at is 434, and at this point, what we're looking at is if the market's able to close above 460 3/4 prior to breaching 434, then the potential for upward momentum is higher. If the market closes below this 434 mark prior to breaching this 460 3/4 number, then we believe that the previous low should be breached, and our target coming in at about 413 or lower should be reached within the coming weeks. It's going to be interesting to see the way in which wheat continues to move, but for now, because of the nature of the global supply, we anticipate that the markets should continue lower. Here we have a look at the December crude oil contract, and if you recall, we had a minimum price objective of 52.80. The market hit this mark last week, and in doing so, the market has since reversed. If you recall, we just talked about the 1.272 price level. This is where we were able to derive the $51 mark for this particular contract. You can see that when the market first tried to make its approach, it found very good consolidation up against this level. Once it was finally able to breach this area, it came up to our Fibonacci 1.618 number, and from there the market has since reversed. We now sit at a very critical zone for this contract, and like before, if this market's able to get back above this 1.272 number, we think the potential for continued strength may be there, where the market could possibly make a run to 54.75. Right now, it is looking weaker. We anticipate a potential retest of previous lows coming in near this 50% retracement mark, near 47. So right now, we'll simply sit on our hands. If you've been fortunate enough to capture some of the move to the upside, at the very least, we hope that you've taken some profits up near that 52.80 mark, and at the very least are tightening some stops. So for now, we'll simply be waiting for the next opportunity to materialize. December cotton has returned to its volatile ways. We had discussed in the past the fact that the market had been trading inside of a key tunnel area, where the bottom of the tunnel and the top of the tunnel had been containing a good portion of the price action over the past 2 to 3 weeks. Most recently, the market did break below that tunnel area, but has since flipped back above inside of our tunnel today. In doing so, it looks like the market could very well remain inside of this training tunnel. And as long as it stays inside of here over the course of time, we can anticipate the potential for increased volatility, because as long as the market stays inside of this tunnel trading area, you can see that the tunnel is expanding. And in doing so, if the market is to remain contained inside of this tunnel, it's going to potentially tag either side of this tunnel back and forth with some minor breaches on either side. The last time the market broke below the tunnel, you can see that it came back inside, but continued all the way back above on the other side again. Some of the factors that led to the violent movement to the upside and downside have now subsided, but cotton in general still tends to be a volatile market. For now, we're going to look at the top side of the tunnel as potential resistance and the bottom side as potential support. And near term, we're looking at 70.64 as potential resistance for this contract itself. There aren't any opportunities that we're looking at right now in terms of high probability factors. We'll simply continue to wait to see what the market does. The next important time factor that we're looking at for this contract rests on November 4th. So until then, we're simply going to sit on our hands to wait to see if the market can give us a pattern that is more predictable. The US dollar has moved very well off of our 90-degree mark of $91. We talked about this in great detail previously, and as you can see, the market has now made its way up. Most recently, it's now hit up against volatility-based resistance, which coincides with our 180-degree mark. And based off of previous discussions, we've shared with you the importance of when the market hits a mid-cycle area like the 180-degree mark. And as before, you can see the market came in, touched this number near 93.88, and has since reversed back down, or at the very least looks like it is pausing. We like this number here where the market lives at, and we shared before that this could very well be an area for potential pause. Even if the market were to move down from here, we think that support near 92.91 could set in. And from there, the market, if it's able to get back above this 93.90 number, is poised then to make a test somewhere in the neighborhood of 95 and change. In doing so, it would have moved a full cycle from 90 degrees to 90 degrees. And we look at this as a very important potential target near that 95 number for this contract. It also lands at a Fibonacci ratio of 1.618. And so we like very much this area and anticipate very good resistance here for the market to pull back from. On a larger scale, we can see here on the weekly chart that the dollar continued to move up as anticipated. We'll see if it's able to get up close to about the $95 mark. But regardless, we do like the way in which it's been moving, and we anticipate maybe 2 or 3 more weeks of potential upward movement before finding significant resistance. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.